This video is going to broadly cover the state of mining on the ASX, particularly in the microcap space. So let's start with the real obvious stuff. Most junior explorers below 80 million market cap, well, they just don't make much cash. In fact, they don't make any cash at all. In fact, they have high capital expenditure from all the drilling campaigns they need to do, and finding money through capital raising can be really hard, especially when you're burning through so much capital and not showing anything in return. Now, what would most investors prefer? A high-risk speculative mining stock, or something like Fortescue Metals, which returns high-yield dividends? A lot of it comes down to risk versus reward for investors. And how these microcap juniors entice investors is they go, well, we'll offer you a discount to our share price. Now, if you're a microcap stock and you've got about 5 to 10 million market cap, you're probably going to offer 20 to 25% discount on your current share price or on the VWAP price. And it's going to be heavily discounted. You're going to have a lot of dilution. But really, when you're that risky of a stock or a company, there's just no real alternative. You're going to have to offer up cheap shares. And you're going to have to dilute existing investors who obviously won't be happy. But really, that's just the necessary evil for these small companies. If you're a larger small cap junior explorer, then maybe you're sitting on something like 50 to 60 million market cap, and you could get away with a 10% discount or an 8% discount or something in that range. Now, in order for a micro cap or a small cap junior explorer to actually be taken seriously, they need to break out of this mining cycle. Now, I've gone through this in my previous video, and there are a lot of companies that do this. They basically run through this cycle and they rinse and repeat it until they basically just shut down shop, and they might last 5 years, they might last 10 years, but they line up their pockets quite nicely, doing basically nothing. So in order to be taken seriously, a company needs to go through two phases. The first is the exploration phase, which is what makes a junior explorer a junior explorer. It's all about value creation, and it first starts with having a strong shareholder registry. If you don't have a strong shareholder registry, you might not get too much interest in the stock. But that might not really matter, that's just really a starting point. If you don't have a strong shareholder registry, you can hope for good drill results. And basically, as we go up this pyramid, we get more and more de-risked, and the more de-risking there is, the more likely we're going to get other investors interested in the stock, and the more likely the share price and the market cap will rise as well. So of course, once you get drill results, it's all about the pre-feasibility study and the feasibility study and then the development. And of course, when we start development, there's a whole different cycle that we've got to go through as well. I won't go too in-depth in the development phase because that's more for investors than it is for traders. For traders like you and me, who are looking at the small micro-cap space, we're interested in the exploration where the quick dollars can be made and we can just flip in and out. Now, I currently have one video on drill results, and I do plan on making other videos for the feasibility, pre-feasibility, and the shareholder registry. But for now, this is a good high-level view of the pyramid and the steps that we need to take in order to de-risk a mining company. Outside of these steps, there are two things that really need to be considered before you end up trading or investing a mining stock on the ASX. Well, first things first is location, location, and location. Would you really want to invest in an ASX listed company that's running a mine or exploring for a mine in the DRC? Probably not. Would you be rather interested in the Pilbara region, which has a strong history of gold mining? Yeah, that's probably a lot more tempting. Because the rule of thumb is where you find gold, there's very likely more gold to be found. As you can see on this map here, there are just pockets of deposits and operating mines. So that's why nearology is a term that you should get familiar with. If you find a stock that's booming in one commodity, particularly gold, any nearby pieces of land, the stocks surrounding them are also likely to rise on the nearology. Now, the other thing we need to consider is how hot is the commodity? Here's the price of lithium. Now, here's the price of Galaxy Resources, which is GXY on the ticker. It's a lithium-based company in Australia. Well, what about PLS? These stocks just tank because the commodities tanked. So do you know what's booming at the moment is gold. Gold's on the way up. So of course, we're going to see more interest in stocks that involve gold. That's just how it is. It doesn't matter how good of a resource. Let's say we have something that's uranium based. Let's say we just got some world-class uranium. Who's interested in that? How many shareholders are really going to go, oh yeah, I wouldn't mind some uranium? It doesn't matter how good the resource is sometimes. What matters is what's hot. Now, to wind down this video, I want to go over some really basic red flags that everyone should be aware of in the mining space. The first one is the discount size on capital raising and how much they raise. If we have a $5 million market cap company and they discount 35% off the share price, how confident are you as an investor that you just didn't get molested? What if they raised $3 million and they're a $5 million market cap company? Imagine the amount of dilution you just suffered as an investor. So keep in mind that capital raising is a necessary evil, but I mean, there's a difference between an imp and the actual devil himself. There's a certain level of evil that you can go to in capital raising. And the next one is, how many shares do management actually hold? Now this kind of ties in with number one. If management hold a lot of shares and they have faith in the company, do you really think they're going to do heavy discounted raises and dilute themselves and devalue their holdings? Probably not. So if we have a management team that doesn't have a lot of stake in the game, they're more willing or more likely to do heavier capital raising, and they're less likely to care about progressing the company. In other words, we're more likely to see more of this pump cycle just to continue. Now, the third thing is, do management have a bad history? Have they run a couple of companies into the ground in the past, or have these guys actually successfully proven themselves in the field and not just worked for another company, another mining company, but have they actually added value? Have they progressed that company? And is that company still running? These are things that everyone should ask before they invest or even trade a company. The more insights you have into a company, whether you're trading or investing, the more likely you are to be successful. So do keep this in mind. That's the end of this video, guys. Thanks for watching, but I do have one question before you go, and that is, what is the value of the content that I'm making? Is it worth anything to you? If it is, feel free to drop by my Patreon page and buy me a cup of coffee. Why not?